Welcome back. Shares of this company, Keurig Dr Pepper, are under pressure, down by nearly 5%. This comes despite the beverage company reporting an earnings beat in its latest quarter. Let's talk to an expert on the stock. Our guest is Filippo Falorni, a director at Citi. He covers the stock. Filippo, thank you very much for speaking to us. There's two bits of news here. Earnings and a deal to buy Ghost. Ghost is what is referred to as a disruptive energy drink business. The company Keurig Dr Pepper has entered into a definitive agreement. I think the price tag is about $1 billion. Which one of these developments is the source of the earnings decline, in your opinion?
Yeah, thanks for having me today, John. Yeah, look, I think the earnings was clearly the area of pressure for the stock, particularly their coffee segment. Coffee is around 40% of the company. They make the Keurig machines and the single-serve pods. And in the quarter, it was down 3.6%, which was a surprise on the downside versus the street expecting more, somewhere in the down 2%. The coffee category has been an area of weakness generally across the board, both at home and away from home. But I would say the at-home category have had very strong growth during the COVID period, right? 2020, 2021, when people stayed at home. And then they had a period of really normalization of the high level of growth into 22, 23, and even 2024 has really been below average. So the recovery has been less or longer, this downturn, than many companies expected. So that's been really the main reason why the stock is down today. The
company refers to a muted home coffee category. Is it referring to the category across all providers, or its at-home business?
Yeah, I would say, look, if you look at the at-home coffee category, pretty much every form of coffee is under pressure. If you think about roast and ground, coffee beans, single-serve pods, the pod category is actually performing a little bit better than the rest, but not enough. And again, the issue for them is that they had these big penetration gains in the period during the COVID period, and both in terms of like new households entering the base in terms of Keurig machines, and also in terms of the attachment rate, so how many pods are consumed by each household. And it's taking a long time to normalize from the high base, because people then return to more normal away from home consumption. Then there's been some pressure across low-income consumers. And so like this downturn has been, I would say, across the coffee category, but also in their single-serve pod business.
Okay, the company has agreed to buy Ghost. It is an energy drink business. Keurig Dr Pepper says that Ghost's net sales have more than quadrupled over the past 3 years. So it looks like a rapidly growing business. How would this fit into the portfolio of beverages at Keurig Dr Pepper?
Yeah, absolutely. That I think is a bright spot of the report today. Look, clearly, if you think about the composition, as I mentioned, 40% of the company's coffee. The remaining 60% is what they call more refreshment beverages, and that includes their carbonated soft drink brands like Dr Pepper, Canada Dry. But more recently, they've acquired faster growing brands. And they've already had some presence in the energy drink space, particularly with the brand C4, which is a performance energy drink brand. And now they are expanding their footprint into energy drink with Ghost. Ghost has been a very successful brand within energy drink. It was launched in 2016, part of like the Ghost Nutrition company, and then they created an energy drink out of the more protein powder business. And really what they've been able to do is expand with innovation, a lot of different flavors, and get significant shelf space in the category under the Anheuser-Busch distribution. Now, with the deal with Dr Pepper, it allows them to distribute it in their own distribution and further expand shelf space. The brand has already been very successful, quadrupling sales. It reached like about 3%, between 3 and 4% market share in the energy drink category, but there's still a lot of room for them to potentially grow this business.
You say in a note in reaction to these results that you have more you feel you have more visibility. You at Citi have more visibility on the company's U.S. refreshment beverages business. That's 60% of sales, largely because of a scanner data deep dive you've done. That sounds fascinating. Tell us about that.
Yeah, so we look at very in deep dive on the scanner data, which is essentially the track channel US data. So the reported sales at retail of their brands, which get tracked at the checkout machines, right? So what we've really done is look at a lot of their brands, both in the carbonated soft drink space and some of these recently acquired brands, like the C4 that I mentioned. Ghost is new from today, but they also have another brand in Electrolyte, which is a sport drink brand, which is also gaining a lot of traction. And when you look at all these brands and the contribution that they could have, particularly this newly acquired brand, they could have on total company, we're talking about like over 200 basis points of potential contribution to the total company. And so we think that part of the business definitely has a little bit more visibility. The coffee side is the area that has been weaker for them and the area that is driving the downside today. But the rest of the business is performing well.
Okay, you've done a great job of outlining the different segments of the company's business, where the strengths are, where some of the potential weakness is. You do say you think the valuation on the stock is attractive. It now trades at a PE multiple, a forward PE multiple of about 18 times, and you've raised your price target, I understand, to $43 per share.
Correct. Yeah, I think, look, when you think about it, most of their beverage peers trade around 22, 23 times. Clearly, some of the beverage peers like Coca-Cola or PepsiCo, they do have more of an international footprint. So they've been growing faster in some emerging markets. Think about Latin America, Asia, Africa, Eurasia. So there's been, their growth profile is more limited given 90% of sales are in the US. But my point is, given the valuation is already below peers, if they can actually improve the coffee business, which has been the drag on the reported results, I can see them growing pretty consistently in the 4.5% range, which would not be that dissimilar to peers, but the valuation multiple is lower here. So that offers the opportunity. Again, a lot of it is tied to these potential improvement in the coffee business, though.